and welcome to the Money Show right here on ET Now with me, Khurana. We will tell you over the next 1 hour how to not only rise with India but how to multiply your wealth, what are the various and the most adequate, appropriate avenues to invest and be smart about how you manage your money, how you manage your finances. On the show today, we have a whole host of topics lined up. First up and foremost, buying a new house and saving tax. You could enjoy a total of 3.5 lakh worth of deduction on home loans. We'll tell you how eventually on the show. Whether the time is ripe to invest in housing, that's another thing we'll be discussing. And dissecting Kotak Emerging Equity Fund with Pankaj Tibriwal's investing lessons lined up at the last segment of our show. So we have a very interesting lineup, a very interesting host of topics to discuss. So all that is all set for you today on the show. But before that, here's a quick peek at the top headlines of this hour. Nirmala Sitharaman. Education and health. Well, Nirmala Sitharaman talks about the budget on the floor defense, the budget map in Lok Sabha, saying that the budget quite clearly reflects government's commitment to boost investment in agriculture, education and health. Interglobe Aviation stock nosedives as promoters wash dirty linen in public. But CEO assures staff in a letter that the spat will not affect operations and it will get resolved eventually. This even as analysts fear spat may spiral into a major headwind for shares. ET Now told you first about the differences between the promoters. Fireworks missing from TCS Q1, but management confident of clocking double-digit FY20 growth. Cautious analysts slash targets and EPS estimate, but believe margin resilience should be limited in terms of downside. Nifty ends below 11,500 for the first time since May 17. All sectoral indices end in the red. Auto, PSU banks, metals and realty lose over 1% each. Motown stuck in slow lane. Domestic car sales down 25% in June, with passenger vehicle sales also coming down around 18%. Karnataka political crisis spills over in Mumbai. Karnataka Minister D.K. Shiv Kumar and Congress leader Milind Deora Sanjay Nirupam detained outside Hotel Renaissance in Mumbai after they were stopped from meeting the rebel MLAs camping in the hotel. Meanwhile, former Chief Minister B.S. Yediyurappa says Kumaraswamy has no moral right to continue as the CM. Team India in huge trouble after the semi-final resumed today. Lost 4 wickets in the first 10 overs with just 24 runs on the board. Men in blue face an uphill task of chasing 240 runs against the Kiwis. Alright, let's kickstart the Money Show then. Welcome on board our first guest, Priti Khurana, Chief Editor of Clear Tax, joining us right here on the show today. Priti, hi, good evening and welcome on board. Now, there are a whole host of issues to be talked about, especially in the aftermath of the various announcements made in Budget 2019. But today, let's try and focus more on the housing space and how consumers and the Aam Aadmi stand to be impacted after the budget announcements that were made in the housing department, especially in the housing sector. But first up, before we delve deeper into that, one should understand and one should get a better sense of why one should actually, invest in real estate as one of the avenues to multiply their wealth and also get some tax benefits out of it. So perhaps you can start by explaining our viewers the benefits of, the tax benefits one could avail if they invest in a house or any kind of a property.
Right. So, if you look at the Income Tax Act, there are specific benefits available when you purchase a house property. So, if you are investing in a house property, in that case you can claim a deduction on the interest that you pay on the home loan. So if you've taken up a home loan to finance the purchase of your house, whatever interest you pay on it, you can claim a deduction under the Income Tax Act, and you can reduce your total taxable income, but the maximum limit allowed is rupees 2 lakhs. So if you have a house property, you are repaying a home loan, and the interest portion that you are repaying, a maximum of rupees 2 lakhs you can claim in your tax return. Now how do you go about that? So you report that interest deduction as a loss under the head house property, and whatever loss you have, which is maximum restricted to rupees 2 lakhs, is allowed to be set off from your salary income or other sources income. So effectively your total taxable income comes down. When you are repaying a home loan, your total taxable income comes down and you pay lesser tax. On top of this deduction, if you are repaying the principal portion, which usually actually comes into the picture only a little later, maybe a few years down the line when you start repaying the principal, then you can claim that principal repayment under section 80C. So you have a gross taxable income, and then from that you claim 80C of maximum 1.5 lakhs, and then you end up paying even lower tax. So people who have a home loan usually have a lower disposable income, or they have lower funds to actually go and invest to claim 80C. To them it is really helpful that they are able to claim the repayment of principal under section 80C. So broadly this is the real benefit, that you are able to claim interest on deduction. Now recently in the budget which was announced on 5th of July, the government has said that it's going to provide an additional interest deduction of 1.5 lakhs on homes which do not cost beyond rupees 45 lakhs. So if you are buying your first house, remember the condition is that this should be your first house and you don't have any other house in your name, and you buy this house in the financial year 1920, with the one which is going on right now. You purchase a house in this financial year and its stamp value should not exceed rupees 45 lakhs. In that case, you will be able to claim an interest deduction of 1.5 lakhs, and this is in addition to the rupees 2 lakhs which are already allowed. So effectively you will be able to claim a 3.5 lakhs deduction on the interest that you pay on your home loan.
Fair enough. Thanks for being so so concise and so clear about that. But what about renting a home? There are some benefits that one can avail as an employee or as somebody who's a tax-paying citizen when they rent a house as well. Can you throw some light on that as well?
Right. So if you have a house property which you have rented out, of course you have to pay tax on the rent that you earn. So your rental income is taxable under the head house property. Now from this rental income, the government allows you to deduct whatever property taxes you have paid during the year. So this could be, even if you paid say last 3 years property taxes, in the current year you claim all of that. So it's on paid basis. So rental income less property taxes, and you have a net value. From this net value you are allowed a 30% deduction, which means, let's say if your net value after deducting property taxes is, say for example 1,20,000, then 30% of that is allowed as a deduction, and your taxable income under the head house property on account of rent remains only rupees 80,000, because 30% is allowed as a standard deduction towards maintenance or repairs, whatever you have carried on, whether or not you have carried on in that year. 30% is a flat deduction, and from the remaining amount you can further deduct any interest that you are paying. So if you are paying home loan interest, you can go on and deduct that further. So let's say if you have 80,000 rental income in this example, and you have a 2 lakh rupees or 3 lakh rupees of interest outgo, then you reduce that from 80,000 and you will end up with a negative figure in your calculation. Let's say it's 3 lakhs of interest and 80,000 of your net rental income, then you are actually having a loss of 2,20,000, but the maximum that you can claim as loss is restricted to rupees 2 lakhs, right? So in that sense, if you have a rental property, then you have rental income and you claim your property taxes, you claim a 30% deduction on flat deduction on the net rental income, which is your rental after reducing property taxes, and further on you can claim interest on home loan that you have paid, and the loss that you get can of course be reduced from your salary and your other sources income, interest income, and that way you can reduce your total taxable income and end up paying lower tax. Now this is this happens when you have a rented property, when you have let out your property. Even then the maximum loss in one financial year that you can set off is restricted to 2 lakhs. But if your loss exceeds that, like in our example we had a loss of 2,20,000, so the 20,000 rupees you are allowed to carry forward to the future financial years. But the only restriction is that in the future years, that 20,000, the carried forward loss, will only be set off from house property income, which usually does not happen because you don't have additional house property income, but effectively you are able to claim slightly higher interest deduction when you have a rented property.
Okay, that's very insightful, Preeti. Let's also talk about the kind of incentives that were doled out in the budget last week. Of course, there was a big fillip given to first-time home buyers, the affordable housing segment. But overall, what is your assessment when it comes to the budget for an average tax-paying citizen, for somebody who has a middle income or somebody who falls in the middle category? How would you rate the budget this time around? And if you talk about specific things like housing or personal tax slab, of course there was not too much difference as far as the personal tax is concerned, but overall how would you assess the budget?
Right. So in my view, you have to look at the two budgets, the interim and the full budget which has come now in as together, right? So you have to look at both the proposals together because half of the proposals were kept in the interim budget and the remaining half have come now, but both the budgets actually apply for the current financial year, which is 1920. Now if you look at it in totality, you will see that for this financial year, those who have income up to rupees 5 lakhs who can restrict their total taxable income to rupees 5 lakhs will not pay any tax, right? And the surcharge will only impact those who are earning between 2 to 5 crores or those who earn above 5 crores. Now the good thing is that the middle bracket effectively does not pay any higher tax because of the budget. So that's one good thing, that there's no higher tax. Now coming to relief. Of course, there were a lot of expectations. People wanted the exemption limit to be raised from 2.5 lakhs to at least 3 lakhs, or perhaps that ATC could be increased from 1.5 to 2 lakhs. But none of that came through. The government is actually focused on two key things right now. One is affordable housing, which they have shown some intent. They've said that they are also going to allow the builders section 80IAB, which means that they will also be pushed to provide affordable housing which does not exceed rupees 45 lakhs, and then they have a deduction for purchase of electric vehicles. But other than this, of course, there are not too many benefits. So in that sense, I would rate the budget somewhere around, say, about 6, because of course there was expectation that did not come through, but fortunately the middle income bracket, they do not face any higher burden of taxes. That at least has not happened. But what I am really hopeful for is that the government is working on a new direct tax code, and that should actually simplify the tax a lot. It should focus on better tax administration, it should focus more on simplification, and that should be good news for everyone.
Hope for that, Preeti, as well. But let's start with the viewer queries as well and see what is the kind of questions they have to ask you. First up, we have a query from Shiv Kumar. He's emailed to us and he says, I would appreciate if you could explain on tax exemption announced in this budget for startup on account of residential property sale. For example, if he is given an example as well, if I had sold my flat for 1.5 crores and I'm investing 25 lakhs or so initially from this proceed into the startup, will my capital gains tax be 0, or should I file any special form for this as well? So it's a very specific query that he has. Perhaps he wants to divert some of his money earned from a property sale into a startup. Can you advise him on the same?
Right. So this is actually laid down in section 54 GB of the Income Tax Act, and this is a specific provision which, if you look at it very simply, it says that if you are selling a residential house property and you want to invest the capital gains into a company, then your capital gains can be completely exempt from tax, but you have to follow a certain pattern. So firstly, you sell the house property and you invest your capital gains in a company, but you as the person who has sold the property, you should hold at least 50% of the share capital of this new company. Now this new company should use those proceeds, the money that you have invested, for which you have been given 50% stake, the company has to use those proceeds to buy an asset. So it should purchase a new asset in the name of that company, and only then, when these three steps are complete, that you have sold the property, you've invested your capital gains, you've got a 50% stake, and that new company has purchased an asset, is when you will get capital gains exemption. But there are certain restrictions. You have to be certified by an interministerial board, so that company should be an eligible business. They've specified what kind of business you can be in. There's a turnover threshold, so you cannot cross 25 crores of turnover, and you have to meet the conditions, and of course get an approval from the interministerial board to be eligible to make this kind of transaction, and for your capital gains to be exempt from tax.
Okay. Let's move on then, Preeti, to our next query as well, and this is from Mr. Rajesh Uttam Moti Ramani. He's emailed to us and he has a two-part query, or rather, it's a two-part query. He just to give you a detail about his profile. He's 50 years old. He's a single central government officer paying a tax income in the highest slab, which is 30%. He's contemplating to make a gift by check in favor of his niece, who would attain a majority in terms of her age on at the start of 2020, and he also contemplates to open an auto sweep saving bank account in her name with her father and his elder brother as the guardian. So he wants to give essentially a gift to his niece at this point, and he has two questions now. First, can I get a PAN number in the name of my niece? Would it be a normal PAN card, or would it be something separate that is done for minors? Secondly, he wants to know what would be the tax implication of such interest earned on auto sweep savings bank account, whether the interest income up to January 28th, a day before the niece turns 18, would be clubbed in the income from other sources of her father or of the person concerned. Because he's saying that as per his knowledge, income tax law, the income tax of the particular financial year wherein one assessee attains majority is treated as his or her income. So once again, a very directed, a very particularly and a very specified query you have, and two-part questions, if you could address both of them.
Right. So firstly, we look at PAN. Of course, anyone can get a PAN. That person could be a minor or a major, and the PAN is exactly the same. So there is no special PAN card for minors. They have a PAN card just like a major would have, an adult would have. Now coming to the question of what would be her status in a particular financial year if she is turning 18 in that year, right? So at any time during the financial year, if a taxpayer, if an individual is turning major, that person is a major for tax purposes for that financial year. So in your case, let's say if she is turning a major in January, in that financial year she will file a return as a major. Now coming to any income of minor versus a major. Now when a minor has an income, such an income is usually clubbed with the income of one of the parents, the parent whose income is higher after such clubbing. Okay, so unless the minor has certain income by virtue of their own skill, so let's say they won a gaming show, or they are talented, they went for a contest and they won a prize, in that case such an income will be their own income. But if they receive a gift, or if they let's say have an interest income from a bank account which is actually the money has been deposited by a relative or by parents, in such a situation clubbing will take place with the income of the parent, whoever has a higher income. Now because this person that you want to give to, your relative, she is actually going to be a major, therefore no clubbing will happen, the income will not be clubbed. So that's one part. The other part is, what is the tax implication when you are giving her a gift? Now you want to give her a check, some money, and you want her to have the facility to sort of receive an auto sweep or whatever, certain payments through your bank account. Now when that takes place, this is actually a gift between two people who are not considered a relative as per the Income Tax Act. The Income Tax Act has specified what is the definition of a relative, and unfortunately she is your niece, and in that sense your relationship with her is not that of a specified relative, and therefore whatever gifts you are going to be making to her, of money or of property or whatever it is, these will become taxable in her own hands. So therefore the receipt of gift will be an income for her, and she'll have to report it in her own tax return, because she's a major. She'll report it as a gift under the head income from other sources, and she'll have to pay tax on it.
Okay, wow. Thanks, Preeti, for addressing his very specific, very detailed query at that. Let's move right on then to our third query. This is from Nisha Khurana. She's a first-time home buyer. She has a budget of 70 lakhs and she wants to know how to minimize her down payment requirement, because her existing corpus is very limited. So she perhaps doesn't have enough money saved or money banked up for paying up her down payment. So what would be your advice? How should she go about it if she has to buy a house now?
Well, actually, I would highly recommend to buy whatever she can afford at the moment, and if she is able to get a loan from a bank based upon some kind of a guarantee that can be provided, if she has salary slips that she can offer and look at a higher loan outpay, that would be the best way. But effectively, it's best to stay within what you can actually repay and what you can actually feel that you can afford right now. That's what you should look at.
Okay. All right, Preeti, there's one more query then before we, let you go. We have to address this one as well. Praveena Naidu got in touch with us. She wants to know, under the affordable housing scheme, she says there are some benefits given specifically to women as well. So wants to know if she can club her benefits as a female buyer along with the overall benefit that's being given to the first time home buyers as well, and what is the tax benefit that women are entitled to avail.
Right. So, as such, in the Income Tax Act, there are no specific tax benefits for women, no specific tax benefits based on gender, and especially in this new affordable housing which has come through. Perhaps I think she's mentioning about loan facility which can be offered to women at a slightly lower rate. Other than that, I don't see any other benefits that she can club with affordable housing. But when she's taking a loan for claiming this deduction for buying a house, which is up to rupees 45 lakhs, which is covered under 80EE, she has to make sure that the loan is taken from a financial institution or an NBFC, and it's only then that she'll become eligible for the tax deduction. Maybe she has to look at specific women related schemes, but so far as the Income Tax Act is concerned, no specific tax benefits for women have been put into place towards affordable housing.
Okay, Preeti, thank you so much for joining us and for being so patient and helping our viewers out with their very specific queries in detail. Thank you so much once again. Pleasure chatting with you. On that note, we're going to slip into a short break. We have plenty when we come back, so stay tuned. Welcome back. You're still watching The Money Show on ET Now. And before we dig deeper into the housing and real estate segment, let's take a quick breather. Mubina is standing by to get us a very exciting, very engaging interaction with Mr. Pankaj Tibrewal of Kotak in our Meet Your Fund Manager segment. Let's take it across to her.
Hi everyone, this is the Meet Your Fund Manager segment where we catch up with fund managers from various mutual fund houses and talk to them about what is it that keeps their fund so alive and kicking and what's their investment strategy. Today we decided to talk about the Kotak Emerging Equity Scheme. As the name suggests, it invests in emerging names and more so in the small and mid-cap names, so the risk as well is moderately high. Now let's talk about the returns. Definitely great returns, especially from a longer term time horizon. 17.5% in 7 years, 11% in 5 years and 9% in 1 year. What is it then that they are concentrating their portfolio on, or rather which sectors is it that has the maximum exposure? It's the financial sector. Just like many mutual funds, the financial space is something that's catching this fund's eye as well. So a nice 20% allocation to the financial space, and then industrial manufacturing has approximately 15%, consumer goods 12%, and then pharma, fertilizer, cement as well as chemicals have approximately 6% each. If you look at the names, you'll notice how all of them are in very niche categories. I'm talking about the stocks, and the maximum exposure for the whole fund is in PI industries, more than 3.5% in PI industries. And then you have a small cap South Bay cement company Ramco Cements, where Kotak Emerging Equity has put in almost 3.6% of the assets. Atul has 3.4%, AU Small Finance 3.3%, and Supreme at 3.2%. So like I said, lots of mid and small cap names in the fund. So let's now catch up with the fund manager, Mr. Pankaj Tibrewal, to talk to him about what is it that unit holders should watch out for when it comes to this fund, and what's his own investment strategy. Pankaj, thank you for joining in on ET Now. And first let's introduce the fund to our viewers, the Kotak Emerging Equity. As the name suggests, yes, it invests in a lot of these new and up-and-coming companies. Well, not necessarily new, but yeah, smaller names which are hopefully going to become big sooner or later. Let's talk about your investment strategy, or rather, what's the basic theme of the Emerging Equity Scheme?
The Kotak Emerging Equity is a mid-cap scheme, and predominantly it focuses on investments in mid and small cap companies. Over the years, the basic thought process and the construction of the portfolio has been bottom up with an eye on the benchmark, which is CNX Midcap 100. Our endeavor in this is to own high quality businesses which probably over a period of time can multiply and become large caps. If you look at the portfolio today, about 73-74% of the portfolio is invested in mid-cap companies, which means, as per SEBI definition, companies ranging from 101st to about 250th in terms of market cap. About 15 to 16% of the portfolio is in small caps, and the rest is between large caps and cash. So the idea is to have quality businesses run by very efficient and able managements, focusing on right capital allocation. We are very much in favor of owning businesses which have very strong cash flows and healthy balance sheet and offer earnings growth at a reasonable price. So that's the way we can continue to select stocks in the portfolio. If you look at the portfolio, Kotak Emerging Equity has a very low churn. That means we like to own companies over longer periods of time. Also, the basic essence of the portfolio has been to avoid mistakes. I think the basic tenet of the scheme is that we have not run only after trying to find out the next multi-baggers, but over a period of time we have realized that in mid and small caps, if you try and make less mistakes, I think that's also a winner strategy. I think that's the way we have run our portfolios for a very long period in Kotak Emerging Equity.
Pankaj, in a world where we are looking at INFSs and DHFLs and all these risks really plaguing a lot of funds, given the fact that mutual funds did tend to have exposure to all of these kind of companies and their instruments, how do you, Pankaj, weed out the bad from the good?
So I think we have a late set out process. I think one of the things which helps us in kind of weeding out the good from the bad is return on capital. I think the companies over a period of time which offers decent return on capital with good moat in their businesses, definitely you can identify between good and bad. The second portion we kind of trying to identify is whether that company has a strong balance sheet and cash flows. To us, top line is vanity, bottom line is sanity, and cash in bank is reality. And that's something which we are sacrosanct of, that cash flows is something which matters us a lot. And over a period of time, if you try and own companies which are run by efficient and able promoters, which comes from experience over the past history, I think that's where you will avoid mistakes. I'm not saying we will not make mistakes, but the mistakes should not be so large that it drags the return on the portfolio for a longer period of time.
You know, Pankaj, just taking a look at some of the top stocks that you have an exposure to. Like I said earlier, I see a PI Industries where there's a more than 3% exposure. There's also Ramco Cements, Atul. All of them have this theme that they are very niche companies. So what's, what is it that you look at when you're picking out these companies then? What is it that you look at the first thing in terms of the balance sheet, perhaps the profit and loss of these companies that makes you believe that, yes, this is a good investment bet?
Make sure that first of all we are not running the company, so we have to trust the management who are running the company, and we should be able to put trust and faith on them. We are okay even if the company goes through a bad patch of few quarters, till the time the long-term value of the company is still intact. So at times when good companies are available at cheaper valuation, when couple of quarters they have missed earnings, I think that's the time we become a little more greedy and try to own quality companies at reasonable prices. The third thing, which obviously I have mentioned again, is to us balance sheet and cash flows are more sacrosanct than only the profit and loss account. Yes, earnings growth matters, but not at the cost of cash flows and balance sheet. I think if you keep these few basic investment principles in mind, I think over a period of time you would avoid bad corporate governance companies, you would avoid companies with many red flags. And we are seeing in the environment over the last 12 months that there are issues emerging in various companies where they have promoter pledge, there were issues of corporate governance, there are issues on financials and balance sheet and so on and so forth. So I think that's where our focus lies, that don't try and search for the next multi-bagger every day. Let the winners take care of themselves. If you avoid losers, winners will take care of themselves. That's our basic philosophy.
Financial services is a key component of your fund. What is it that makes you so optimistic about that sector?
So we believe that if you want to write the India story, there are two basic things which you need to have exposure to. One is consumption and the second is financial services. In financial services, we are underweight PSU banks. But if you look at, we are overweight on private sector corporate lenders, and that's been our stance for a long period of time. We are underweight the NBFC sector as well. And that's not from today, but from maybe 2017 when the valuations were very, very expensive. We believe that in India, these two themes are the major themes one should be riding on. And depending on the view and the cycle of the market, some of the other themes like investment-led themes or the export-led themes take precedence. As of now, we believe that in the corporate sector private lenders, the asset quality seems to be stabilizing. The pain which most of the private sector corporate lenders have taken over the last couple of years in terms of higher provisioning seems to be behind us, and over the next 2 years, the earnings growth seems to be extremely strong. So that's one reason where we are believing that financials should perform going forward. However, if you look at versus the benchmark, we are underweight because in benchmark you have a lot of PSU names which we don't want to own at this moment of time. On the consumption and the industrial space, we believe that consumer discretionary over a period of time should do well. We are at almost $2,000 per capita income, and we have seen a complete hockey stick whenever any country crosses the $2,000 per capita income, and the consumer discretionary names tend to do well than the consumer staples names. So we have some of the mattress companies, some of the names on the auto ancillary space, and so on and so forth. On the industrial side, we believe that there are early indicators where we are seeing early capex-led recovery, and we believe that that industrial cycle should start picking up. Government's focus on roads, railways should be back again, and that should bode well for the early cycle plays. We are not saying that the late cycle plays will start performing immediately, but we have started our portfolio positioning, owning a lot of investment names where it fits into our investment philosophy, which is return on capital, cash flows, and balance sheet. So I think that's where our sectoral positioning is today of Kotak Emerging Equity.
And finally, Pankaj, what's a message that you would like to share to all the unit holders, both current as well as prospective, on what is it that they should look at when they are investing in the Kotak Emerging Equity scheme?
The basic message which I would like to give it to all my existing or potential unit holders is that this is a mid-cap fund, so have some appetite for volatility. Also, you can be rest assured that we like to manage your money as our money. We would like to own businesses which we would continue to want to own for a longer periods of time. Yes, we will make mistakes. The mistakes should not be large enough so that it drags our return for a longer period of time. And also, in bad markets like over the last 12-8 months, our endeavor will be to make less mistakes and make sure that we generate alpha over the benchmark in times to come. So that's been our core philosophy, and that's the message we would like to send it to our viewers and our unit holders, that this is a fund which will try to maintain consistent performance over a longer period of time.
All right, Pankaj, thanks a lot then for joining in on our Meet Your Fund Manager segment. There you have it, Khurana, a very interesting fund. Do remember, of course, the risk is moderately higher for this one. So that's something that investors should be a bit cautious about. However, Pankaj has, of course, given us an in-depth analysis of what exactly is it that his investment style is. So, hey, folks, if you do like it, go ahead and subscribe to this fund.
Absolutely. Thanks for those details as well, Mubina, with respect to the entire, analysis of the fund that you did before we touched base with Pankaj. On that note, we'll slip into a short break. We have a very exciting conversation lined up on the other side. Stay tuned. Welcome back. You're still watching the Money Show right here on ET. Now, let's also once again touch base and talk about what essentially is happening in the realty space in the Indian real estate market. But before we do that, here's Awan with a special link for us, and she gets us a sense of how exactly the movement of property prices has been across the country.
Well, let's give you an assessment as to how property prices have shaped up over the country. We'll begin with the financial capital, and that is Mumbai. It's seen a meager rise of about 3.5%, perhaps deferred purchases amidst the economic slowdown, the elections, as well as the overall banking crisis. Moving on then to the capital, New Delhi, and that's seen a rise of just about 3.3%, so a little bit lower than what we've seen in Mumbai. Bengaluru, on the other hand, and as we're moving south, we're seeing the trend really pick up. So for Bengaluru, you've seen a rise of about 7.8%. Is there going to be a halt on the construction of new properties? All of that's going to raise question marks. Meantime, in Ahmedabad, it's been a very meager rise. So you've seen property prices go up by a meager 1.8%. If we look at Kolkata, and that has seen a rise of just about 3.4% in the property prices, and traditionally you had seen prices move up very smartly in this region. Moving on then, for Lucknow, it's been a sizable improvement in the overall property prices of nearly 6.4%. Chennai has seen a considerable move, and that's the trend that you're seeing as we go south. You've got Chennai, which has seen an improvement in the property prices, which has grown nearly 13.8%. Kochi has seen the maximum rise, in fact, and property prices over here in the region have risen by almost 30%. So 28% is what you're seeing in the region of Kochi. Kanpur, the story is quite different, and in fact, there's been a drop in the prices, a negative 6.6%. So that just gives you an overview as to how property prices have really shaped up.
Thanks, Avan, for that. Let's also welcome in our guests. We have Gulam Zia joining us right here on the show from Knight Frank. Gulam, thank you so much for joining us on ET Now. Just want to get in firstly a sense of how the real estate market is panning out. There has been a very modest momentum in the prices, in the demand scenario as well. But the question is the momentum likely to build up? Will it continue growing, or is it likely to be a little subdued, at least in the near to medium term?
As you rightly mentioned, that the current situation is it's pretty subdued right now, and momentum where we see actually is in the mid to lower end of the market, which is actually affordable housing. Especially the upper end of the housing has been very tight, is not really performing at all, we can say so. Main action was into below 50 lakh rupee property prices, wherever the ticket size is below 50 lakh. That's one segment where we have seen enough of momentum happening. And in fact, this is the segment which has actually come to the rescue of otherwise a real estate sector which was showing very lackluster performance. And this is the sector, once again, if you look at it, the incentives under Pradhan Mantri Awas Yojana, etc. are also are the main reason for it to move in that direction. And in the recent budget, the proposal that has come about to give another subsidy in terms of interest subvention or on your home loan mortgage rates, you have a very healthy interest swap also coming in, giving you almost about 6 to 7 lakh over a period of your mortgage duration. All those things put together are making it extremely good situation for the mid to low end of the housing. So going forward, the way we look at it, this segment, which is affordable and mid segment, is something which shall continue to thrive, and the upper end is where there will be more bloodbath or there will be more trouble for many of those developers who don't see end to the luxury and the super high end apartments from the market. So that is where I believe going forward we have to relook at how we actually define real estate. In past, we have actually continued to create housing stock in a certain category of luxury and super luxury without any particular focus on where is the demand for that kind of a housing. But in past and recent past, with so much of initiatives, etc. taken up from the central government, the focus is definitely shifting towards mid to low end of the market, and which is what will define how the future for real estate is. If the stakeholders are adjusting themselves to the need of the larger masses, obviously real estate shall thrive. If not, we may still see more pains ahead.
You know, you were talking about a lot of pain being witnessed in the luxury and in the high-end segment. Does it have anything to do with, to a great extent when it comes to government regulations like GST, like RERA coming into play? Because earlier the speculation or the perception was that a lot of black money is being parked in these segments, and especially the luxury and upper end. Is it because of these regulations and government tightening its noose on such activities?
Well, for sure, as far as tightening the noose on black money is concerned, is definitely a key to where all these high-end markets are really coming to almost a grinding halt, because that's where the increased price rises were expected to be, and that's where actually the investors were parking their money. The markets that I was referring to earlier, the mid to lower end of the market, is essentially thrived or is where you will find mostly the end users alone. The high-end investors are not really getting into lower end of the or bottom of the market, which is why the current situation of the real estate is shifting towards mid to low end. The high end, as you rightly said, was where a lot of black money was coming in, and with a couple of these regulators or tightening the noose on that has come about, the high end of the market is as good as completely wiped out, and no investor and hence absolutely no interest in that segment of market.
Well, that's rather unfortunate and rather extreme, but let's talk about the mid and the affordable segments. The government definitely is pushing it in a big way. There are a lot of infrastructure and construction and road building activities also taking place in a lot of these tier 2, tier 3 markets where a lot of these affordable segments are coming up. Any trends that you are witnessing that you'd like to highlight to our viewers as well who are looking to perhaps invest in any of these markets, and which are the most promising or most buoyant geographies or sections that you are identifying right now?
Infrastructure development is really the key of where the future of real estate lies. And as you rightly mentioned, what was happening earlier, maybe say 5 years back or a decade back, we did see a lot of these affordable housing projects launched or taken up by many corporate developers, etc. But unfortunately, these locations were where the infrastructure was lacking, and because of which the end user interest was really not falling in place. So many of those projects were suffering purely because they landed up over there only for the matter of low land costs, but then because of lack of infrastructure, things are not moving. But now, in last at least half a decade for sure, pretty much in all top of these 7-8 top cities and even more, lot of infrastructure activities are happening, and these are mass rapid transport systems which are connecting one part of the city to the other very beautifully. If I talk about Mumbai, almost about 10 metros are under construction. In Delhi, another 3-4 metros. In pretty much all of these top cities, you have a lot of these metros falling in place, and that is giving access to those hinterlands or remote areas which were earlier not really favored by the end users. But with infrastructure falling in place, these huge land masses, which are actually pretty affordable, are coming in as raw material for us to construct affordable housing, and that has also given a huge boost for affordable housing. And that is where in future, as you asked me, your question was, where is it should I look at for affordable housing and where future could lie? Well, if I talk about Mumbai, the far off belts of Vasai Virar region to Kalyan Dombivli or Panvel, all of these regions will be once again beautifully connected to the entire mainland of Mumbai. Same is the case with Pune, where they are connecting the heart of the city to, on one side, Pimpri Chinchwad, and on the other side, the whole IT corridor. So these are locations where we should look at, where earlier there was no infrastructure connect, but today or maybe in a year or two, we shall have beautiful infrastructure falling in place. These are the places where end users must look at exploring for a very good deal for them to find their house of dream.
Okay, Ghulam, thank you so much for joining us. I wish I could have chatted with you a little more, but we're a little pressed on time. But really appreciate your insights and your views on the real estate market and the trends that are shaping up in our country as we speak. With that, we're going to wrap it up on this edition of The Money Show. Thank you so much for tuning in.